see. Hey, welcome to Academic Market Insights. I am Dr. Russell Rhoads from the Kelley School of Business. And as always, I am joined by Dr. Alpha from the Kelley School of Business. Say hi.
Good morning, everybody, or good afternoon.
So right now it's late January, and we're starting a new semester, and we've got a lot of overlap between students, and we actually got I'm stealing your thunder,
Okay.
Dr. A, but we got overlapping questions from students. I'll see students at noon, and then you see them at 3, right? Is that how that works? So they
And sometimes it's 6 for my evening
and sometimes it's 6 as well. But we do have a few overlapping students, and I got the big question in undergraduate derivatives. Dun dun dun. What is VIX? And you know, it's something that I used to be with the Chicago Board Options Exchange, used to work in the education division. I have, well, there it is. There's a VIX book up there that I wrote. I've spent a lot of time on VIX. Used to be if you said something bad about VIX, we were talking about this yesterday. I was at a trade show once and somebody called VIX a scam, and I had to be restrained because you can't say anything bad about my girl VIX.
Well, and
yes.
I'd like to jump in. My sister also has a girl crush on your girl VIX. So she loves the Volatility Index exchange. And I'm going to steal a little bit of your thunder. And she studied psychology as an undergrad, and she is a user experiencer. So her entire job is the science behind why we do certain things, specifically with websites. So the philosophy of understanding market behavior and this behavioral finance aspect of it, because really that's what VIX is. It's a behavioral finance. She loves it. She totally geeks out. And she was thrilled to get a copy of your book. And so, yeah, my sister fangirls on your girl VIX.
It's one of those things that everybody hears about it, but I don't think a lot of people fully understand what VIX is telling us. And this is the very high level definition of VIX. We're going to stay very high level today, but this will likely not be the last video that we do about VIX because there is an awful lot to talk about. And I am teaching it this semester at Kelley. But what VIX does, it takes the implied volatility of a wide number of options that are listed on the S&P 500 or the SPX options, which is one of the most liquid option markets in the world. And in order to get a consistent 30-day measure of volatility, we take option pricing from the Friday just before a 30-day time frame and the Friday just after a 30-day time frame, and they get time weighted together. Use it basically, and if you really want to get into the weeds on this, I suggest you read the VIX white paper. I have a student who claimed to have read the VIX white paper. I'm not 100% sure if that's true. So if you really want to get into how the options are chosen, the best thing to know is that it is basically all the liquid out of the money calls and out of the money puts on SPX that expire just before and just after that 30-day time frame. And again, it's the Friday expiring options. We've got options expiring every day now. And my buddy Steve Sears over at Barron's and who works with the Brodsky family now, I think he's still doing some work with those guys. He coined the phrase fear index. And that's because when they're scared out there, and this is the behavioral finance part of it right here, when there's a lot of concern about what's going on in the equity markets, basically the S&P 500 is down some, you will see VIX move higher. And the reason that VIX will move higher when we get a drop in the S&P 500 is you'll see increased demand. It's people trying to buy insurance when the house is on fire. You'll see, I mean, that really is the way to put it. You will see increased demand for S&P 500 put options. Now, VIX is calculated using both calls and puts, but almost all of the time, changes in VIX really being driven by the put side of the equation. We trade about 1.5 puts every day for the number of calls in the SPX arena. So, we come in on a Monday morning, something bad's happened in the world, and the S&P 500 is down 3 or 4%. Portfolio managers are a bit worried about locking in gains, and they are locking in any or guarding against losses, may even be a better way to put it. If they're stepping up and buying insurance through buying S&P 500 index puts, that is going to push the implied volatility of those options higher and results in a higher VIX. Yes.
So have you seen or read any research regarding the volatility smirk and the VIX, if there's a relationship there? So the more pronounced the smirk, perhaps the higher the
Well,
VIX?
not necessarily with VIX, but what I have, and I'm sure there's some people that have done some research in that space. What I have actually done to get an idea of how VIX is being driven at times, almost like an attribution analysis. And I've
Mhm.
done the numbers. I've never written anything up about it. But on Bloomberg, you can get a consistent 30-day implied volatility measure on anything
Okay.
that has options. Now, I'm not going to say the integrity of markets that don't have a whole lot of liquidity is that good, but I think with SPX, those are pretty good numbers. And I will actually look at, because you can get a consistent 30-day measure, download it off of Bloomberg. I will look at the 5% out of the money calls and the 5% out of the money puts versus each other.
Okay.
And quantitatively, that's really where I am getting that statement that things are being driven by the put side.
Mhm.
There are volatility indexes and implied volatility that gets driven by the call side, especially commodities and we'll get into that as well in a later video. But there are commodities. If you have entities that get hurt with higher gold prices, and you have entities that get hurt with lower gold prices. So if gold's rallying, there's going to be some panic buying of calls. If gold is dropping, you're going to see some panic buying of puts. You don't see panic buying of calls when the S&P 500 is moving higher, because the majority of stock market participants are net long stocks already. So there's not this panic that maybe the folks over at Tiffany's they're going to have to charge higher prices at the holidays unless they lock in their gold price. Now, to kind of demonstrate the anticipatory and the reactionary nature of VIX, VIX is almost always reactionary, but sometimes implied volatility will start to creep up when we have something like a presidential election on the horizon, or there's a VIX in Europe, the V stocks, and V stocks is behaving in a funny way because we've got an election next month in Germany,
Mm.
and they're bracing for the outcome of that. But here's the S&P 500 and VIX every day in 2024, and I'm not sure if I can. I don't think I can get a pointer. I'll just use my mouse here. But you can see right here, we did have what we would refer to, I always referred to the stock market selling off very quickly as a volatility event. It's a
Mhm.
nice way to put that a lot of people lost money. You also, one of the tough things about being a VIX evangelist is you get really excited when everybody else is getting hurt, and you got to temper that stuff. You gotta not you've got to you can't get all excited when early August is happening and a bunch of people are panicking. So
Well, I do appreciate, I believe you sent me a text. VIX is above 60. Like
yeah,
I don't know that it did get above 60 or whatever it was, that
yeah, it
threshold.
did.
Super, super excited. And if
Yeah,
I remember correctly, that's the carry trade, right? That's
it
when the
can
carry.
be it can be thought of that way. The issue with creating a carry trade around VIX is the other side of it.
Mhm.
And actually, you're giving me a great leading question there. Because, well, I do. Let me talk about this just a little bit more. You can see in the April-May timeframe that the S&P sold off, and this first sell-off, the VIX went to a higher level. When we made new lows in the S&P 500, we were also, I'm sorry, made new highs in the S&P 500. We started making new lows in VIX, and we'll really get into using VIX as an indicator in a later video as well. But you can see instances where the stock market is we get a sell off, and then we get a second leg of the sell off. It actually shows up even better in August here, where we got a sell off and then we kind of double bottomed right there. And you can see when we're testing that bottom, I wish I could zoom in on this chart. VIX is already working its way lower.
Right.
And typically when VIX is working its way lower, the night of the 2016 election, VIX started going down before the S&P 500 recovered from the sudden surprise that Donald Trump was getting elected when he got elected 8 years ago. So you can see that reactionary stuff. You can see some anticipatory stuff like right here. Just the one last look. It's kind of, right here with the November, above November 24. You can see VIX moving up and the stock market was moving up a little bit. This was moving up into the election. And then the election went very smoothly and basically VIX sold off, et cetera. And one little dip in December. And I think people were a bit surprised on that one. But they were surprised if VIX runs up very quickly like that. It came right back down very, very quickly. Okay. So we were talking about, so the big issue with VIX is unlike stock market indexes. For the S&P 500, if I want to get basically Delta 1 exposure to the S&P 500, I can do so through buying a basket of stocks. I can buy an ETF. There are multiple index-oriented ETFs. I can buy S&P futures. They pretty much have a delta of 1 related to what's going on in the S&P 500 as well. With VIX, you can't get direct exposure to spot volatility or to the spot VIX index. And recall when I was talking about the calculation, we're using 2 different Friday expiring series. We're sitting here on a Friday, so 28 days out is one series that's feeding in, and I believe the other one would be 35 or 36 days out. The 28-day series, the ones that expire 4 weeks from today, they're becoming less of a weighting every minute. And the longer dated, it's becoming more of a weighting every minute. And because of that, to try to replicate VIX, you really would need to be we would need to rebalance multiple times throughout the trading day. And the trading costs of trying to do that make it prohibitively expensive to try and replicate VIX. So there's no fair value relationship between spot VIX and the VIX futures. And typically the VIX futures are at a slight premium relative to the index. And that's, you can think of that as compensation for option sellers or for people that are selling volatility. They deserve a little bit of a cushion in there. And as I said here, spot VIX is at 15 and the front month future is at 16.50. Well, that $1.50 premium is really a risk premium if you're thinking about shorting volatility. And the farther out we go in time, in kind of a quiet, normal market environment, that number will start to work its way higher. And if we get some sort of a spike, and I'm using my quote machine to do this, but I'm going to go back to that day in August where we had VIX get up over 60. Spot VIX closed right up there. It closed up almost at 40. The front month futures contract closed at 32. Mm. So you see this and you're like, oh yeah, I'm going to go short VIX up there close to 40. In reality, your best alternative for shorting VIX was down around 32 or so.
Sure.
So you don't quite get the bang for your buck that you're hoping for the upside if you own VIX, and we get, again, what I refer to as a volatility event. You do well. I mean, that August contract, VIX was up about 20 points that day. That August contract was up $10.25 that day.
Got it. Wow.
At 1,000 multiplier, that's not so bad.
It's not so bad.
At all. So we don't have that fair value relationship, but VIX options and VIX futures do settle into, and I say a unique VIX calculation. It's a unique VIX calculation because it uses one series. The Friday, again, I wish I had a calendar in front of me, but the Friday that is 28 days in the future from, and again, today's January 24th of 2025, that would be February 21st, which is the third Friday of February. A couple of days ago, when we had January VIX settlement, the settlement price, the settlement level for VIX futures and options was based on only February 21st options. So it's
Mm,
based on the series that is exactly 30 days out in the future. And that makes sense because it's 30 it's a 30-day calculation.
right.
So, and that unique VIX calculation, sometimes it can deviate a bit from where spot VIX is trading, but typically it's a pretty good indication of where VIX was for settlement purposes.
Excellent.
So, and that's really, I know we're trying to tighten up the videos a little bit. And I mean, when we talked about this yesterday, I think I said something like, this could be a 2.5 hour video. I've
Well,
written
I
2 whole
believe
books
you
on the
could
freaking
actually,
topic.
if you really wanted to, this could be a 2.5, 3
I
days.
know, and I've done
Some,
that in the past.
hmm right.
So yeah, maybe a VIX seminar is in the future. I haven't done those in some time. So this is one thing that a lot of people are going to like to know, and I'm going to expand on this in future videos. But I really would like to address questions that people have about VIX. Put a comment below. You can shoot me an email. That's my consulting email address, so you don't get lost amongst all of my students, etc. So there. And with that, I'm going to let Larissa take us out because I got a very upset dog behind me.
Oh no, I hope your dog is doing okay. But everybody, I hope you enjoyed this video. I enjoyed this video. I know my sister is going to fangirl and watch this video, and she's going to like this video because it's the fear index. So if you liked it, please hit like. Also, if you're interested, please subscribe. We're trying to figure out the frequency that we should be doing this and things like that. And if you have interesting topics or just topics in general that you're interested that relate to the financial markets, we are happy to take suggestions. And if you have constructive criticism, we're also very happy and willing to listen to that. With that, thank you so much for joining us. And Dr. Roat, thank you so much for walking us through the VIX.
You betcha. I'm going to go pet my dog now.
Yay.